But first, for analysis, Jill Malandrino, VOA business correspondent, joins us from the New York Bureau. Hello, Jill.
Hi, how are you?
I am terrific. How are the markets reacting to the Brexit so far?
Well, it's been interesting because the first 2 days following the Brexit vote, we saw a significant sell-off in the markets. Now, prior to the sell-off, we were just about 2% away from all-time highs. So while the sell-off was exaggerated, you have to remember the levels that we were coming from. Over the course of the past 2 days, actually a day and a half, because we're still trading at this point in the U.S., we are just about 3% away from all-time highs. So there has been quite a recovery here, which is understandable because there's been a lot of beaten down sectors and stocks that kind of traded in sympathy along with the broader markets. I also find it interesting, in addition to the commodity, some currency recovery, and clearly the equity market recovery that we've seen, bonds have not sold off. And usually they trade inverse with the equity market. So it still shows that there is some volatility, a lot of uncertainty out there. So I think we'll really start to see what the impact will be probably going into next week, because we are trading into the end of the quarter, which is tomorrow on Thursday. And you typically see what's called window dressing in the U.S., where portfolio managers will buy equities to put into their portfolios. So you tend to see bullish action around that. I think next week, and when we start earnings in the second week of July, is when you're really going to be able to tell how the markets have been impacted.
If I understand you correctly, of course, that might mean the global markets. What about as far as the African continent is concerned? We're talking about mainly South Africa, perhaps, and Nigeria.
Right. Well, South Africa has the most exposure to the EU and the UK for trade. In fact, the UK is South Africa's fourth largest trading partner. And of course, Nigeria, Kenya, Rwanda, Uganda, all those countries that are really up and coming in the east and west part of Africa are involved with the EU as well. One thing with the South Africa you have to watch is the action in the rand. We've seen a recovery in the rand, and we've also seen a recovery in gold prices, which is interesting because the South African market rebounded on that because a big part of their index is comprised of gold mining companies. Outside of the markets, I would say the biggest issue is going to be developmental aid, and all the other poverty aid resources that are sent to Africa from the UK. Should the UK go into recession, and I'll use their development aid program as an example, 0.7% of the gross national income is allocated to developmental aid in Africa. Should the UK go into a recession, I don't think they would not participate in that allocation. But as the UK makes less money with their gross national income, that will be less money going to Africa in real terms, in terms of the pound.
Talk to us, to what extent does, for example, or do the African currencies continue to have confidence in the British pound sterling?
It's really hard to tell at this point because there is no framework that is laid out. This is going to take time. They say that there'll be a 2-year period of when they will renegotiate all of these trade agreements and so forth. I don't think it'll happen within 2 years. I think what we're going to see is with this Brexit vote, perhaps more leverage on the table when the UK goes to discuss this with EU leaders. I think the biggest issues right now is immigration and sort of the bureaucratic control that Brussels has over the UK. I think that's where that popular vote was surrounding Brexit. So it's too early to tell what's going to happen with trade agreements. I would watch for clues in the bond markets and, of course, in the local currency markets in Africa.
Are you in a position to share with us how it may look like in the medium and long term?
Well, I'll tell you what, for the short term, when I was first asked about this on last Friday, my advice has always been to long-term investors, don't time the market. Professionals can't do it. You certainly can't do it. In your retirement accounts, don't try and trade around an isolated event. That's why we have averages. Kind of let the noise in the market play itself out. Let global markets reestablish their ranges, and look at your account in 5 to 10 years from now, because you don't want to miss out on great opportunities that could have been excellent buys for your portfolio. For example, in the U.S. markets, when we hit that low in the S&P 500 in 2008 with our financial crisis, the market has rebounded almost 300% since then. If you would have tried to isolate that one market event, you would have lost out on tremendous growth in your portfolio. So just like it's going to take patience and time to figure out how this referendum is going to be handled, you have to give patience and time for your longer term portfolios as well.
To what extent would you say you are surprised so far as far as the dynamics are concerned?
You know, I'm more surprised on the social and political level, and we can understand that a lot in the U.S. with our national election cycle. We are seeing a strong populist movement here as well. There is every day there's something new with a mass shooting or a terrorist attack, and people are becoming more protective of their countries, and they want these borders built up. So I wasn't quite as surprised to see the Brexit vote, although the markets weren't really signaling that was going to happen. But I think on a larger scale, this is something that everyone across the globe has to be concerned about. And now that the hangover is over from the Brexit vote, you have to figure out what's going to happen next, because we are so globally intertwined, economically, socially, politically, and I think that's really what the case is here. The trade agreements will work themselves out. It's just going to require some time.
Thank you very much, Jill, for interacting with us.
Thank you.
You're most welcome.